So this standard is another brand new standard for the ACCA students because they are experiencing this standard at SBR, which they have not experienced in prior subjects, FR or FA. Now, what this standard looks at or deals with is when the settlement is happening in relation to or in relevance to equity instruments of the organization. Now, using equity instruments to settle a transaction or settle to a supplier or settle to an employee, it can take two main forms. Number one is equity settled transactions or equity settled share based payments. Now, this is a situation where the settlement itself happens using the equity instruments of the organization. It could be shares or share options. All right. Then there is cash settled share based payment. Now, this is a situation where an entity is obliged or obligated to settle using cash, but in relevance to the share price on the date of settlement. So here, the cash amount is not fixed because cash amount that is to be settled is dependent on the share price or the equity instrument price on the date of settlement. All right. Then there is a third option, which is a choice. Now, choice between using equity settled share based payment or cash settled share based payment. Now, choice could be given to either the entity or either the entity has choice or the counterparty has choice. Counterparty are the parties with whom the transaction is taking place, from whom the company has obtained goods or service for which they are supposed to pay. Right? Now, the payment is what is happening using the equity instruments as the base. Okay? Now, the entity has a choice whether to settle in equity settled, whether to use equity settled or cash settled. Entity would use cash settled if there is an obligation to settle using cash. Could be one possible reason could be where the entity is not allowed to do transactions or settle any transactions using the equity instruments. They are disallowed. Could be through regulatory environment. Could be through the past practices. So based on that when there's a past practice that they settle using cash, in that case also it becomes an obligation for an entity to use cash settled share based payment method. Okay, the two ways: one, there's an obligation, or one, there is a past practice. Obligation meaning a legal obligation, past practice meaning a constructive obligation. So if there's an obligation, then they will be treating it as cash settled share based payment on their financial accounts, and then they will be using equity settled when the settlement is intended to happen in equity and there is no obligation of making settlement using cash. So in that case, the entity will use the equity settled share based payment method. But when the counterparty has a choice, it creates a compound instrument. It creates a compound instrument. Okay, so we are going to look at all of these in detail as we proceed into each of these areas. Right? Then there is vesting conditions. Vesting conditions. Right? But before we come to vesting condition, counterparties, let's look at who the counterparties could be. Right? Counterparty can either be a supplier or it can be an employee. Okay? So we looked at IAS 19 a short while ago. So in IAS 19, what do we look at? When there's employee benefits using cash, we know it's pretty straightforward. Now here the employee benefits, meaning the employee services, are paid or compensated using equity instrument as a base. So in that case, IFRS 2 share-based payment is what applies. Okay? Right. So supplier can be a counterparty, employee can be a counterparty, and for supplier, vesting conditions happens immediately. Vesting happens immediately, right? Immediate vesting. But for employees, it requires to meet the vesting conditions. Now, what is vesting? Vesting is a process in which, or process through which, the counterparty becomes entitled to share-based payment. Vesting is a process through which the counterparty gets entitled to share-based payment. All right. Now that process has conditions that we need to look at. All right. So there are conditions that we need to look at. So what are the conditions? There are two main conditions. There is service condition that requires an employee to work for a certain period of time in order to become entitled. Let's say the service condition says the employee needs to work minimum 3 years in order to become entitled to the share-based payment scheme. So only if employee works for 3 years, the employee becomes entitled and the company has to settle. If the employee does not complete the 3 years, there is no any obligation that the entity has. That's service condition, completion of service period. Then there is performance condition. Now this is based on performance of the organization. Now performance condition could be internal or it can be external condition, right? It can be market based or it can be non-market based conditions, right? It can be market based condition, it can be non-market based condition. So when it comes to a market-based condition, you are required to ignore it because we assume that market-based conditions are already captured in the fair value of the shares that are being traded. Okay. Now here we also come at the fair value at the grant date, fair value at the reporting date. So that we'll look at shortly. So the fair value itself has considered market based factors. Therefore, market conditions, if it is given, you can ignore that. But non-market conditions is dependent on entity's performance from an internal perspective. All right. A market-based condition could be share price. Share price should be this much, right? The transaction should be this much. That's market-based. So we assume the market-based is already included in the fair value at any point, whatever fair value we're using. It's included there. But non-market performance conditions such as revenue, if the entity earns revenue of 500,000 and above, meaning 500,000, $750,000, right? In that case, it will be vested. If this condition is not met, no vesting. Okay, so that's performance condition, non-market based. So whenever you are dealing with the transactions of share-based payments, whether it's equity settled, cash settled, the service conditions and non-market based performance conditions need to be considered and accounted to. Right? You need to consider it and you need to account that amount. All right. So then comes the fair value. All right. Now there is going to be a tree of choosing what fair value fits the most. Is the share-based payment to the employee? You ask that first question. All right. If the answer is yes, then you use fair value at grant date. So grant date is going to be the date on which the transaction was approved or they got into the transaction on that date, right? The date on which the transaction they got into, right? There was an agreement. So that becomes a grant date. So on that date, there would be a fair value of the shares or equity instruments. So that fair value is what you are going to use. So fair value at grant date is what you are going to use if it is an employee. But at each reporting date, you will keep changing the values based on the service conditions and non-market based performance conditions. But there will be no change to the fair value that's being used. Okay? If it is, now this we are dealing with equity settled share-based payment. Okay, equity settled share-based payment. If the answer to this question is a no, right? So it's going to be fair value equal to the carrying amount of the transaction of the underlying item, right? Underlying item. All right. As underlying item is the goods or service provided by the supplier. Now there is a catch here also. All right. Now the fair value of the goods or service, can it be measured reliably? Now here you will be asking another question. So let's go through that question process. Yeah. So now you ask the question, can the fair value of underlying item, which is goods or service, be measured reliably? Okay, you ask this question. Now here also it can take two forms. One is yes, you can. So in that case, use fair value of goods or service. If the answer is no, then you will be using fair value of equity instruments. Okay. So the question process that you're going to ask is the share-based payment to the employee? Is the counterparty an employee? If the counterparty is an employee, fair value at grant date. If the counterparty is not an employee and a supplier, then you ask another question, can the fair value of goods or service be measured reliably? If the answer is yes, use that value. If the answer is no, you will be using fair value of equity instruments. Okay? But more often than not, since the accounting treatment is complex for the employees, and the counterparties are employees, your questions around IFRS 2 for SBR is going to focus on share-based payment where the counterparty is an employee. Okay, so when the counterparty is an employee, equity settled, cash settled share-based payments are treated in different ways, where the equity settled share-based payment is dealt with under equity, and cash settled share-based payment is dealt with under liability. Okay, this under equity, this under liability. But when you are doing the accounting, you need to consider the service conditions and the non-market based performance condition in order to arrive at the figures. All right, and throughout the vesting period, you will be accounting it in your accounts until until the employees become entitled and the service condition is completed. All right. Okay. Right. So moving on to the accounting treatment for equity settled share based payment. All right. Accounting for equity settled share based payment. Here we are going to have an expense and we are going to have a corresponding equity. Now, as SBR students, you all are required to critically assess and evaluate standards as well. If you critically assess and evaluate a standard, in this case, debit expense, credit equity goes against conceptual framework. Why? Because conceptual framework defines an expense as an increase in liability or reduction in an asset that in turn reduces equity. But what's happening here? Expense is increasing, equity is increasing. So this goes against the conceptual framework principles. But what does IFRS say? When conceptual framework says something, IFRS says something, IFRS takes the precedence always. Since IFRS says this is the treatment, this is the treatment. Yeah, you can critically evaluate, you can critique it, but still you'll have to continue using this. Okay? Right. Now, how does accounting work? It's dependent on service and performance condition and fair value at grant date. So this we are dealing with counterparty being an employee. Okay, counterparty and employee. So what are the main factors that you have to consider? Service condition, non-market performance condition, right? Non-market performance condition, fair value at grant date, and number of equity instruments provided. So these are the four main elements that we are going to deal with when we are doing the accounting. All right. All these four elements are going to be dealt with when we are doing the accounting. And the accounting will change throughout the service period depending on how many members of staff or how many employees are expected to leave and how many have actually left. Okay, how many are expected to leave, how many have actually left. Now let's take an example. Let's say there are 1,000 employees, right? 1,000 employees. Out of this, now the service condition is 3 years, right? So you're going to account it throughout the 3 years, right? Year 1, expected leaver 20, actual leavers 30. Okay. Then year 2, expected leavers 35, actual leavers 20. Year 3, actual leavers 15, no expected leavers because there is no any further expectation. So in year 1, what happens? Actual leavers are 30 and they are expecting further 20 to leave. Year 2, what happens? Actual leavers are 20 and they are expecting further 35 to leave. And third year, actual leavers are 15 and there are no any expected leavers because the conditions have been met. Right now we are at the actual situation. So how do we deal with the accounting here? Right? And let's say each employee gets 100 options, and fair value at grant date. Fair value at grant date is $10. Okay, $10 is fair value at grant date, and 100 options are given to each employee that remains. All right, so there is no non-market performance condition. Let's simplify to understand how to deal with it first. Okay, right. So you put a table. You put a year. You put years here. Working expense equity. Okay. Now year 1. How does the working work? How many employees do we have? We have 1,000 employees, out of which we are expecting, we actual leavers in year 1 have been 30 and we are expecting 20 to leave in the next year, 20 to leave next year, right? 30 actual leavers minus 20 expected leavers, right? So that's 1,000 minus 50 in total. So how many staff are we looking at now? 950. Each staff that is going to remain is going to be entitled to 100 options each. And what's the fair value of the 100 options at grant date? $10. You're going to use $10 there. And this is the first year. What's the service condition? 3 years. So it's first year of 3 years. 1/3. All right. So if you look at the math, it's going to be 950 into 100 into 10 into 1/3. Okay, it's going to be 1/3. So 950 multiplied by 100 options each. 100 options, the fair value of grant date is 10. Now this 1 over 3. So 316,667. 316,667. So you debit expense by 316,667. You credit equity by 316,667. Year 2. Now we have a better situation, more realistic situation on year 2 as to what's happening. So we actually have 1,000 staff, out of which actual leavers during the first year were 30. Actual leavers during second year have been 20. And we are expecting further 35 to leave in the next year. Further 35 to leave. So this is the staff that's going to remain. In 200 per staff that remains, the options given. 10 fair value of option at grant date. This is the second year. 2 over 3. Now if we do the math, it's going to be different. 1,000 minus 85. 1,000 minus 85. So that's 915 staff. 915, each staff gets 100. 91,500 into $10 is the fair value granted. Fair value granted does not change, right? 915,000 into 2 divided by 3, right? So that's 610,000. So equity will stand at 610,000, and expense is going to be the difference between 610,000 and 316,667 minus 316,667, because you recognized that already in the last year. So the expense will be recognized in this year would be 293,333. Likewise, as we move into year 3, we have real situation. Out of 1,000 staff, 30 left in the first year, 20 left in the second year, and 15 left in third year. So actual staff that are remaining are being entitled. 1,000 minus 65. So we have 935 staff that are being entitled to 100 options each at $10 fair value grant date into, now this is the third year. Okay? Into 100 into 10. So that's 935,000. 935,000. So the difference between these two, 935,000 minus 610,000. So that's the expense, 325,000. Now if you take the total of this, 325,000 plus 293,333 plus 316,667, you arrive at 935,000. So these both balance. All right. So that's how you deal with the accounting. Every year you do the accounting based on service conditions, how many staff are going to remain, right? How many have actually left, how many are expected to leave in the next year. And then you make an estimate. So each staff that remains will be entitled to how many options? So 100 in this case, and that into the fair value at grant date. What's the fair value at grant date? It is 10 in this case. And then every year you do the proportionment, right? Apportionment is done every year based on the number of year that is. Okay, so that's how you deal with equity settled share based payment. Every year, what do you do? Year 1, how does the double entry work? Debit staff cost in operating section of 316,667 and credit equity, which is going to be share capital and share premium if it's above, right? 316,667. Year 2, double entry would be debit staff cost 293,333, and your equity also increases by the corresponding amount, share capital 293,333. And year 3, the double entry would look like debit staff cost 325,000, credit equity 325,000. Okay, so that's how you deal with the equity settled share based payment. So now let's move into the accounting treatment for cash settled share-based payment. To give a quick snapshot, this would look like debit, expense, credit, liability. Now there, the fair value did not change. Equity settled, there was no change to fair value because fair value grant date continued. But in this case, even fair value keeps changing. Fair value keeps changing to the fair value at the reporting date, right? So every year, the math that you do is going to be based on the fair value at the reporting date. Okay, right. Now here, what's important? You call it share appreciation rights because you have to settle in cash for the number of shares, right? So what's the rights that's given there? Share appreciation rights is important. Fair value at reporting date is important. Conditions, vesting conditions are important. Both service plus non-market performance conditions are important here. All right. And then number of year is also important. All right. Which number of year is it is also important. And most importantly, employee count. Now, vesting conditions is where you have the put it under here. Employee count. Okay. Employee count there. Right. Now, these are the aspects that you are going to deal with when you are dealing with the cash settled share based payment. Now, let's do an example here. Yeah. Service condition 3 years. Number of staff 1,000. Right. The rest remains the same, meaning this part remains the same. Expected leave is 20, 30, 35, 20, 15, 0. Okay. That remains unchanged. Yeah. Now we have fair value. Year 1 fair value is 8. Year 2 fair value is 6. Year 3 fair value is 10. Okay, we have fair value here. All right. So how are you going to treat this? Similar table. Year, working, expensed, and liability. Okay, here we have liability. Year 1, we know that we had 1,000 staff, out of which 30 had left and 20 are expected to leave. 30 had left, 20 are expected to leave, right? So share appreciation rights, let's leave it at 1,000 itself, or 100 share appreciation rights. Yeah, 100 share appreciation rights. Yeah, so 300 my 1,000 minus 30 minus 20. Okay, so each of them, the share appreciation right that they're getting entitled to is 100. Now at the end of year 1, it's $8. All right, $8. Multiply, that's the fair value. Multiply by 1:3. So what's going to be the math? Let's calculate that. If you calculate that, 950, 100 into 100 into 8, 1 divided by 3, 253 triple 3. 253 triple 3. Now year 2, 1,000 staff, 30 had left in the year 1, 20 had left in the year 2, and 35 were further expected to leave, right? 35 were further expected to leave. All right. 35 for the expected leave. So that's 915 staff into 100. Fair value is 6 into 6 into 2 over 3. So that's going to be into 100 into 6 into 2 divided by 3. So that's 366,000, and expense is going to be the difference between 366,000 and 253,333. That's 112,667. Then comes year 3. We knew that there was 1,000 staff. 30 had left in the year 1, 20 in the year 2, 15 in the year 3. So that's 935 staff. Each became entitled to 100. And what was the fair value now? 10 was the fair value. 10 into 3 over 3. All right. 935 staff, 100 each at $10. That's 935,000. 935,000. All right. So that's the difference between 935,000 and 366,000. 569,000. Now, if you take the total is going to be 935,000, which is going to tally. So what's the difference? Here we debit expense, credit liability, and the working has a change of fair value as fair value at the reporting date. But in case of equity settled share-based payment, there was no requirement of changing the fair value. Rather, you consider service conditions and performance conditions. So based on service condition, the employee count changes, performance-based, non-market based performance conditions. So that's a little detailed and complex area, which we will look at in detail when we start doing the calculations and doing the examples. All right. Right. Then there's a third way, choice of settlement. Choice of settlement. Now, if if the entity has the choice, cash settled, if there's an obligation, so it follows the cash settled method. Equity settled, if they're settling in equity instruments, then you follow the same as equity settled share-based payment. Counterparty has choice, that's where things change. Counterparty choice. Right? So this is compound instrument, meaning this is going to have both equity and liability components. Equity and liability components. So how are you going to do the math or the accounting for this one? Let's look at that. But before we look at the accounting here, remember in liability there's one more area, which is when the settlement happens. When the settlement happens. So at settlement, the employees are paid intrinsic value. Although liability considers fair value at reporting date, the settlement happens at intrinsic value. Intrinsic value is the difference between share price on exercise date minus exercise price, because there would be an exercise price that would have been agreed. So that is what intrinsic value is, and intrinsic value is the value that is going to be paid or settled to the employee, and that creates deferred tax. That creates deferred tax impact, right? Why? Because accounting treatment happens at fair value at reporting date, while the settlement is to happen at intrinsic value. Intrinsic value at settlement date. So this creates a deferred tax. This creates a temporary difference. So that creates deferred tax impact. All right. Okay. Now let's look at the choice option. Now here, equity, we give this the term equity root. We give this term share root. Okay. So on the grant date, we have to calculate the equity root equity route as well as share route. Okay, we have to calculate the equity route as well as the share route. Now, equity route is going to be calculated as number of equity instruments entitled into fair value at grant date. Okay, number of equity instruments entitled into the fair value at grant date, right? So equity route and not share route. It is going to be a quick correction. It is cash route, share route and cash route. So we call it share route or equity route and cash route. All right, share or equity route or share route, and we use this as cash. The term that we use is cash route. Okay. All right. So we have share route and we have cash route. Now, cash route is going to be number of SAR, share appreciation rights, into fair value of share price at grant date. Right? Fair value of share price at grant date. Now, this could be different to this. Now, this fair value at grant date could be different to fair value of share price at grant date. Now, fair value at grant date would be the amount that they would be agreeing to explicitly. But fair value of share price at grant date is based on the market share price in the market. Fair value at grant date will not be the share price in the market, rather an amount that they agree to, right? But this one is going to be the share price on the market itself. All right. Now let's say the option that was given was 20,000 shares at 4.90 each. Now this is the fair value at grant date. Right, so this is the case for equity. Or 18,000 SARs given. And for this, now we have to look at the grant date share price, reporting date share prices, right? So grant date share price, let's say, is $5. $5. Now we have equity route amount and we have cash route amount. What's the equity or share route amount? Equity or share route amount is going to be 20,000 into 4.9, which is 20,000 into 4.9, 98,000. And share route or cash route, not share route, cash route is 18,000 into 5, which is 90,000. All right, 18,000 into 5, which is 90,000. Now this would bring a fixed amount to equity component. So now we have the equity component value, $8,000. This is the equity component, remains unchanged. The value remains unchanged. Okay, but liability component is dependent on share appreciation rights, fair value at reporting date. All right. So which component is remaining fixed here? Let's go back to the example of equity settled share based payment. 100 into 10, right? 100 into 10 is 1,000, right? $1,000 remain unchanged. $1,000 remain unchanged, right? Why 100 each into 10? So this is where 8,000 comes in, right? So in this context, in the compound instrument context, 8,000 remains fixed here, but the other conditions will change. This and this will change. This part will not change, but this and this will change for equity instruments as well. So let's look at a very simple example to understand how we are going to deal with a compound or a choice of settlement where counterparty has settled the choice. How are we going to deal with the equity and liability component? All right. So you have liability, you have equity, and you have year. Let's assume it's the same 3 years service condition, right? 3 year service condition. So the vesting period is 3 years. Okay. And let's assume there is no change to the share, the employee count. Employee count remains as it is. Okay. So make it simple. There is no change to the employee counts at all. Right. So if there is no change to employee counts, we know that the working would happen in a more simplified manner. All right. So let's say 18,000 was what was given. Yeah. So liability. So 18,000. And reporting, do we have fair value at reporting date? Reporting date, let's have for 3 years. Year 1, it was 5.5. Year 2, it was 6.5. Year 3, it was 7. Okay. Right. So, and let's keep it only for one employee. Let's not overcomplicate, just for you to understand how you deal with it. 18,000 into first year end 5.5, 5.5 into 1 over 3. Equity 8,000 into 1 over 3. We've already arrived at the value there. Year 1. Year 2, 18,000 into 6.5 into 2 over 3. 8,000 into 2 over 3. And third year, 18,000 into 7 into 3 over 3. 8,000 into 3 over 3. So this is going to be how you account for in the context of a choice of settlement. So let's look at the values and then let's look at how the expenses would be. So expense is going to be equal to change in liability plus change in equity year on year. Okay, change in liability plus change in equity year on year. Now let's look at the figures. Let's quickly plug in the figures there. All right, 18,000 into 5.5 into 1 divided by 3. Right, so that's 33,000. Okay, 8,000 into 1 divided by 3. 2,667. Okay, let's round it off. So we know year 2, 8,000. So 8,000 will be split according to 3 years. So that is going to remain the same, right? So the equity ends up becoming 2,667 plus 2,667, which is 5,333. And here it becomes 8,000. Okay. And liability 18,000 into 6.5 into 2 divided by 3. So that's 78,000. 18,000 multiplied by 7. So that's 126,000. So we have both the liability and equity figures here. And expense is going to be year 1, 33,000 plus 2,667. Year 2 is going to be the change. So here the change is 2,667. And here the change is 78,000 minus 33,000, which is 45,000, right? So that is 45,000 plus 2,667. This is going to be the total expense. And year three, we know the change between 8,000 and 5,333 is 2,667. But 126 minus 78 is 48,000. So this is going to be the expense for year three. All right. So it's a change. Expense is a change in liability year on year plus change in equity year on year. And this is how you arrive at the expense. And that's how the accounting works for all three situations. All right. So in a summary, share-based payment or IFRS 2 deals with the settlement that happens with the counterparties, that could be employees or suppliers, for for goods or service that they have delivered. So in terms of employees, it's a service that the company gets, and in terms of suppliers, it's a goods or services. It could be anything that the company gets. So when the settlement occurs using the share as the base, that's where share-based payment comes in. So there are three ways. One is equity settled, one is cash settled, one is when there's choice. So equity settled is where settlement happens using equity itself. Cash settled is where the settlement happens in cash but equivalent to the value of the equity instruments. Choice is where entity can have a choice, counterparty can have a choice. When entity has a choice, if there's an obligation, cash settle. There's no obligation, and if intended to settle in equity, then use the equity settled share based payment method. When the counterparty when the counterparty has a choice, in that case it becomes a compound instrument. So there's going to be a share root or equity root that you calculate, cash root that you calculate. The difference is going to be the equity component, and then liability component keeps changing year on year, same as how the cash settled share based payment scheme applies. But when the treatment happens, the equity settled share based payment, there are conditions. Again, cash settled, equity settled, there are vesting conditions. So you have service conditions, you have performance conditions, which can be market based, non-market based. So you take service conditions, non-market based performance conditions to keep on taking the estimate and changing the figures at each reporting period. So the figures keep changing at each reporting period based on the conditions that have been met or not met. All right. So those conditions need to be considered, and the accounting should happen accordingly. So that applies to both equity settled and cash settled. And when the settlement is happening at cash settled share based payment, the settlement will happen using intrinsic value. And since there's a difference between the actual liability and the intrinsic value based liability or intrinsic value based settlement, there'll be a deferred tax impact that will be created due to that temporary difference. But when there is a choice of settlement, at settlement date, if the entity chooses to convert or to use the equity, or if the employee chooses or the counterparty chooses to go with the equity option, in that case, you de-recognize the liability and recognize the same amount of equity. And that's how the treatment is completed. And that is IFRS 2 for you in a summary.